What is up? Welcome to the second ever episode of Investing Kev. My name is Kevin. We have a lot to get to today, so let's just get right into it. It is June 1st, and if you watched the first video, you already know what that means. The journey begins. And if you didn't watch the first episode, that is totally fine. I will give a quick update. I created 4 different investing strategy portfolios, each one of them kind of replicating what's the more common investing strategies that investors out there in the market follow. And over time, in the coming weeks and the months and the years to come, I want to show you how this portfolio does through the good and bad times. So each portfolio started off with $250 as an initial investment, which is June 1st. We purchased the stocks, and from now on, every few weeks, we will be putting in $100 into each portfolio. And this is to simulate how someone gets like a bi-weekly paycheck and they're only able to put in 20 to 50 to $100 into the market essentially. I want this to be as realistic as possible because I see on YouTube where people are putting in thousands of dollars per week or they have multi-million dollar portfolios, and that is not realistic to majority YouTubers who are trying to learn how to invest. So this is going to be a slow, long burning process, and I really hope that you join me for this journey because we're going to see how things are, and I'm excited to see how the portfolios compare to one another after a year. And I also hope that this shows you and helps you identify which portfolio strategy works best for you, or if you're currently investing, how you can adapt to the times and better understand your vision and who you want to be as an investor. So let's take a look at each portfolio. The first portfolio we're going to check out is the S&P 500 portfolio. This one is to track the S&P 500 index, which is a group of 500 American companies, and many investors believe it best represents the US economy overall because you have pretty much any company out there that represents every single industry from technology to consumer staples to energy, utilities, and industrials. So the reason why I chose the Vanguard S&P 500 was I was kind of researching best S&P 500 ETFs, and Vanguard is a legacy brand name. They are really well known in the investing world. I really believe that they have really strong ETFs that they offer to investors, and the expense ratio is 0.03%. So it is very low compared to other ETF funds. So that is pretty much the reason why I chose it. I thought it was really straightforward. They are identical in how they match the S&P 500 index. So we can see clearly over time how the other portfolios do compared to the S&P 500. So the next portfolio we're going to be checking out is the growth portfolio. These are considered high growth stocks that are doing well currently in their industry, that they're doing well against their competitors, and their future outlook is really bright. I'm just going to give a quick summary of why I picked each stock. Always do your due diligence, but in the future, I will be releasing breakdown videos where we spend more time looking at the company financials, looking at the projections of the company and who they are. So just keep an eye out for future videos where most stocks will be broken down. TDOC is a Chinese electric vehicle company that is considered to be one of the largest electric vehicle players in the coming years. As the world is becoming more focused on climate change, countries are taking the initiative towards renewable energy everywhere from the US to China to pretty much all of Europe. And China currently has the largest electric vehicle market in the world with a lot more room to grow. From what I've read, the Chinese government has said many times renewable energy is the future, and they've already made a strong push towards that initiative through solar, wind, hydropower, and they already have a lot of electric vehicle buses and taxis on the road. I also believe that the Chinese government would want to see their homegrown electric vehicle companies succeed globally, and currently that puts NIO in a strong position, and they're already backing it up with a strong year-over-year growth, and they just expanded in Norway, with future sites in the rest of Europe. They recently ramped up their production, heading into the coming years, where they're going from the current production of 120,000 vehicles per year, and they're going to double that to 240,000 in the coming years. The second stock that I want to take a look at is Apple. Apple is known to everyone. They are currently a $2.1 trillion company, which makes them the largest company in the world by market cap. They have such a loyal following. They focus on the hardware side of things, such as your iPhone, your iPads, your MacBooks, and your Apple Watches. And they also have the software, Mac OS. They're in the entertainment industry with Apple TV, and they come out with TV shows such as Ted Lasso, which is a good TV show, by the way. This company is a technological giant, and they have such a strong ecosystem, it is very hard for people to leave because everything is synced together. And currently, Apple is also in talks for a future electric vehicle car where they're likely going to focus on the battery and also the software for the car. And they're in talks to have a manufacturer such as Hyundai manufacture the car for them. In my opinion, Apple still has so much room to grow. They continue to innovate their products. They have a loyal fan base, and people want to be a part of that Apple ecosystem. The next stock that I want to take a look at is Teledoc Health. It is the global leader in virtual care services. It combines two massive industries, healthcare and technology, and it offers telemedicine access around the world. The reason why I'm big on Teledoc is just seeing what we're going through currently with COVID. COVID made a lot of healthcare offices a lot harder to access because they were either overwhelmed, and just having that ability to have a doctor's visit without having to leave the house, that saves people the time for transportation, but also it could provide a sense of comfort because you're literally in your own home visiting the doctor. I remember watching an interview with the CEO of Teledoc that if someone had a dermatology appointment, they can just upload images of their skin condition, and within 2 days or less, a dermatologist would write out a prescription and plan to the patient. And I thought that was really cool. So, looking at some brief numbers, Teledoc had 10.6 million virtual visits in 2020, which was up 156% from 2019. And Teledoc's US paid membership hit 51.8 million in 2020, which was up 41% from 36.7 million users in 2019. And they're currently expecting 12 to 13 million visits in 2021 with 52 to 54 million users. This company is growing, and I believe there will be a continued shift towards telemedicine as it continues to serve a need around the world, whether it's mental health services, dermatology appointments, or general medical services. Next up is Alibaba. Alibaba is one of the largest e-commerce companies in the world. It is considered the Amazon of China. They currently have 811 million active users in the retail e-commerce space. And if you combine that with all users of their services, such as their cloud computing, they have over 1 billion customers. And that is massive and mind-blowing to think about. Because if you look at the world population, 7.6 billion people live on this earth. And Alibaba currently has about 13% of that population a part of their ecosystem, whether it's e-commerce or cloud computing. And Alibaba is currently dealing with government regulations, and they were recently fined $2.8 billion. But I'm still really confident in this company as China has a rising middle class, and over 52% of Chinese retail sales will be through e-commerce this year. For the first time ever, a country will have a majority of its retail services online. Alibaba is in a rapidly growing industry, e-commerce, and also technology, cloud computing, and other services that they offer, and they hold a huge market share in the Chinese e-commerce space. The last stock in the growth portfolio is none other than Disney. Everyone knows Disney. They resonate with so many people of all ages, and I am confident in Disney because they've taken things to the next level. When you look back at March 2020, when COVID started picking up, they couldn't do anything with their parks or their cruises. Their amusement parks got shut down, and the cruise line industry got shut down entirely. They were originally going to slowly build up Disney Plus, but COVID accelerated their plans and they went all in and it exploded and it paid massive dividends. Not only did they offer nostalgic movies for people to watch, they offered new content such as Mandalorian, WandaVision, which were huge hits, and they also showed Hamilton the musical, which generated a lot of subscribers when they first released it. They own Marvel Studios, they own Lucasfilms, they also own ESPN and Hulu. They're releasing Marvel Phase 4, and they're releasing more Star Wars movies down the road. These are all massive money makers for Disney, and I believe that they will easily be one of the top 3 largest streaming services in the world and may eventually someday be number 1, passing Netflix. Their parks are reopening, and soon the cruise line industry will pick back up, And I believe Disney is well positioned from the amusement parks to their cruise lines and especially streaming services because that's so huge nowadays. The dividends portfolio is comprised of 5 dividend-paying stocks that not only consistently pay a dividend, but have increased their dividends yearly. These are common companies investors invest in to help build their passive income stream, whether it's to help pay for bills now or potentially cover part or all of their living expenses down the road. These are all well-established companies in their respective industries, and a few of these stocks are a part of the Dividends Aristocrats list, which is a group of companies that have increased their dividend payouts for at least 25 years. They are a real estate investment trust company that focuses on real estate. They lease their buildings to a lot of tenants we are aware of. Think of Walgreens, Home Depot, Walmart, Sam's Club, AMC Theaters, 7-Eleven, LA Fitness, and many more. They have a strong retention rate, and they have a 98% portfolio occupation rate, which is a really strong number in the industry. They take pride in being a monthly dividend company, and they are a dividend aristocrat company, having 25 years of consecutive dividend growth. Next up is Prudential Financial. Prudential focuses on life insurance, health insurance, and retirement planning. They've been around for 140 years, since 1880, which is crazy to think about. At this time, they currently have $1.3 trillion in assets under management, and they are the ninth largest institutional asset manager worldwide. In America, they are the second largest life insurer in this country, and they are currently paying an annual dividend of $4.60 per share, which is roughly $1.15 every quarter. Next up is AbbVie. AbbVie is one of the largest pharmaceutical companies in the world. They sell Humira, which is the biggest selling drug in the world, which treats rheumatoid arthritis. 52 million people around the world use their products in over 175 countries. Last year, they finished their acquisition of Allergan, which is known for Botox. So not only are you combining Humira, which is the largest selling drug in the world, but also Botox, which is a growing industry every single year. They also have a vast array of drugs for different conditions, and their continued research for future medication for different diseases puts them at one of the top research companies in the world. At this time, they currently pay an annual dividend of $5.20, which is $1.05 every quarter. And the final stock in the dividends portfolio is Southern Company. Southern Company is a utility company that serves 9 million people in the US. Utilities are a more stable industry, as people will always have a need for electricity and gas. You have a consistent gauge of households, and revenue is stable and it's consistent. Southern Company, they're currently focusing their energy towards renewables as they set a greenhouse gas emissions reduction goal of net zero emissions by 2050. And currently, the company also has an intermediate goal of 50% reduction of greenhouse gas emissions from 2007 levels by 2030. A current issue that they're facing is that their third nuclear reactor is going to be delayed till 2022 as they found some issues during testing. And I remember I read that analysts said like the original cost of $14 billion for this nuclear reactor has ballooned to $25 billion. So it's always something to keep an eye on when it comes to ballooning costs and just issues during development. And that's something to keep an eye on Southern Company. But at this time, they are currently paying a $2.64 dividend, which is 66 cents per quarter. We have finally reached the final portfolio, the balanced portfolio. The balanced portfolio is supposed to be a balance of dividend-paying stocks and growth stocks. We have 2 growth stocks that do not pay a dividend, and we have 2 dividend-paying stocks, and we have 1 wild card in between, which not only pays a dividend, but it is also considered a high growth stock. So let's take a look. Simon Property Group is the first stock that we will take a look at. Simon Property, they focus on premier shopping, dining, entertainment all around the world, from North America to Europe to Asia. Last year, they cut their dividend from $8.40 down to $5.20 to keep the company afloat because malls were shut down for quite some time. So I personally don't hold that against Simon because at the end of the day, they're still one of the premier mall real estate companies. I've been to a few of their properties, and from personal experience, those malls are indeed very popular, whether it was in Colorado or in California. I really believe from what I see from what's happening during COVID, that people really still want to get out, that malls are not dying like a lot of these articles are saying, and that Simon will actually be stronger than before as people want to go back out to eat, they want to keep shopping, they want to watch movies, and they want to travel. They currently pay a $5.20 dividend, which is $1.30 per quarter. The next stock is JD.com. I will actually be coming out with an stock analysis video in the coming days, so keep an eye out for that. I'm very excited because I really believe in JD. JD is an e-commerce company in China. They are actually Alibaba's biggest competitor, but JD just goes beyond the e-commerce world. They focus on technology and they have a huge logistics network that cannot be matched worldwide. They currently can deliver 90% of their deliveries all around China within the same day or the next day. They serve pretty much 99% of China's population, which is 1.4 billion people. They have over 1,000 warehouses. And just like Alibaba, China's retail is going to boom like crazy. In 2024, it's projected to be $6.1 trillion. And like I said with Alibaba, this year is the first time ever any country will have a majority of their retail sales be through e commerce. So I believe JDE is positioned well, and that is why it is a part of the balanced portfolio. So this company is pretty controversial, especially in the dividend investing community. So a few weeks ago, AT&T, they said that they were going to split their Warner Media asset and merge it with Discovery. The bread and butter of the Warner Media asset is HBO Max, and that is why I was invested in AT&T to begin with, because I really believed in the future of HBO Max, and I thought it honestly offers better content than Disney and Netflix, in my opinion. And also, AT&T said that they were likely going to cut their dividend when they split off the company, which is supposed to happen in mid 2022. If you went to Seeking Alpha, there were like 20 articles within like 2 days, with 10 of them telling you to like sell AT&T immediately, and then the other half saying just hold on, see how things go, continue to invest in a good company because AT&T is paying out a high dividend yield for the next year still. And for me, I'm in the latter. I will continue to hold. I want to see how things play out. I know AT&T will split off their company and they will cut their dividend eventually, sometime next year. But I want to see what the Warner Media and Discovery merger, how that goes. So I will continue to hold AT&T. I will continue to invest, get paid out their dividend, which is currently $2.08 annually, which is roughly 52 cents per quarter. At the end of the day, AT&T is one of the largest telecommunication companies in the world. They have so many customers worldwide, and I'm just going to ride it out. And if things go well in the future, things go well in the future. And if not, that is okay. This portfolio will be adjusted a year from now to see if we keep things or we need to reprioritize our holdings. The next stock that I'm invested in is DraftKings. DraftKings is a sports betting company. I like DraftKings because I personally sports bet. I've used other apps in the past for many years, and within the past year, I've switched to DraftKings, and I really like the user interface. I really like the growth and the future prospects of the sports betting industry. From what I read, currently 20 states have legalized mobile sports betting, and pretty much the other states in America, they have something in the pipelines through legislation where eventually, hopefully in the next year or so, or the coming years, that sports betting will be legalized. From what I read in DraftKings quarterly report from January to March 2021, they reported revenues of $312 million, which was an increase of 253% compared to 89 million during the same period in 2020. And I also looked up on a Forbes.com article that the sports betting market in the US generated $1 billion in revenue in 2020, and that number is projected to grow sixfold by 2023. If betting becomes legalized in all 50 states, estimated revenues will exceed $19 billion a year. So you can see this is a rapidly growing industry, and DraftKings is trying to saturate the market as quick as possible. I like their partnerships with the UFC, NFL, NBA, and other sports leagues to come. And I believe that DraftKings, alongside a few other gambling companies, will be the premier sports betting companies in America. And I would not be surprised if DraftKings ends up being number one. And I personally believe they will be number one. We have reached the final stock in the balanced portfolio. Microsoft is a wildcard company. It is both a dividend paying company, but it is also a high growth company. Microsoft is a multi-trillion dollar company. It is currently a 1.9 trillion market cap, second to Apple, which is 2.1. So it is one of the largest companies in the world. When I think of Microsoft, I think of Office 365. I think of Microsoft Word, Excel, Outlook, PowerPoint. These are all products that are used in companies all over the world every single day. I think of Xbox. I think of their Surface laptop. And not only those, I think of their cloud computing like Microsoft Azure, which is growing drastically year by year. Microsoft is a technological giant, just like Apple, and they are ingrained in pretty much every fabric in our daily lives in some capacity. So that is the reason why I'm invested in Microsoft. I like the dividends that they're paying, which is $2.24 annually per share, which is roughly, I believe, 56 cents per quarter. And I also like the growth prospects of this company. As technology continues to expand, they have a lot of legacy brands that will stay, in my opinion, forever for these companies. But they're also trying to innovate and trying to push the envelope and continue to explore future sectors in the technology industry. That was a summary of all the stocks within each portfolio, from the ETF that follows the S&P 500 to the growth stocks, which have really high projections and future outlooks, to the dividends portfolio, where we have consistent dividend payers. I hope this is a good quick summary of why I'm invested in these stocks for the long term. And we will see how these portfolios do against not only each other, but overall. I'm excited. I hope that you guys are excited as well to follow me on this journey. And before we leave, I want to show you guys the Google spreadsheet that I promised that would be free to the community. If you weren't here for the first episode, I said I was going to create a Google spreadsheet where you're able to follow my journey from the very beginning. This tab has all four of the portfolios where you have each portfolio broken down by the current holdings, the amount of shares, the cost basis that have been put into each stock. And there's also donut charts to see like the portfolio weighting by market value. And a few of them have graphs where you can track the dividends over time. And we'll see how much dividends we accumulate as this portfolio continues to grow. On the next tab, we have the portfolio guidelines. These are the set of rules. So if we have people months from now who want to check it out and understand what I'm trying to do, this is kind of like a basic guideline of how the portfolios will go. On this tab, we have a dividend watch list, which is a bunch of dividend stocks out there. It is definitely not all inclusive, but these are just a lot of common dividend stocks that are talked about in the dividend investing community. So I hope this can be like a helpful guide where if you're looking to expand or find companies that resonate with you or learn about totally new companies, this list can be something where you can find stocks of all different sectors and their current dividend yield, how much they're currently paying in dividends, and their 52-week high and low price. And I also have this column where the price is recorded at the end of today, June 1st. And we're going to see the change over time in this column, whether it's lost this amount of percentage or it's gained X percentage by the end of the year. We also have the same thing for the growth watch list. These are a bunch of growth stocks out there. There are some stocks that are overlapping from the dividend and growth stocks, just like Microsoft and Apple would be considered a dividend and growth stock as well. But I hope that this can be a really helpful guide. There are quite a lot of stocks out there. A lot of them I never even heard of. I hope this can be really helpful for the community over time. And also, we also have just basic record keeping. I want to see how much dividends are earned each month. And over here, same thing. We also have the purchase history of the original purchase price of each stock, the original dividend, So we can refer back to it over time. If this company down the road raised their dividends, what was the original dividend when we first purchased it, and what is the PE ratio when we first purchased it, and the earnings per share. And there's also websites to understand more of the company. And same thing goes for the dividend portfolio. If you want to look up what ABBV is about, or realty income and the balanced portfolio. This link will be in the description. You won't be able to edit it, but you will be able to just check it anytime that you feel like. And I hope that this is really helpful to all of you. So thank you everyone for watching this video. I hope you guys are happy and excited to join me on this journey. I hope that you learn a lot from me, or anything at all. I'd be happy if you learned just like something really simple from me. But I really hope that this YouTube channel grows to be something a lot more that is really helpful to as many people as I can reach. So until next time, take care and stay safe.